Hey, greetings everybody. This is Jeff Scott and welcome to this week's review. Thought we'd start off with a beautiful view. Unfortunately, this weekend, this is my backyard in my new house. There's some fire off in the mountains, so it's a little bit hazier. All right, so I titled this week's review, What's That Smell? And it's bad breath. And we're going to talk about that and what I believe the implications might be on the market because of it. It's August 23rd, 2020. My email address, hgsidoc@gmail.com. Feel free to communicate with me. Please note, I don't keep any type of a email list. If you want to receive notification of this, the best way, especially if you're watching it on YouTube, is to subscribe. If you like what I'm doing, do the up thumb. If not, the down thumb. And if you have any messages, communicate either via the YouTube message area or via email. This is for educational purposes only. I'm a doctor, not a broker. I'm independent. I have paid for my tools, and no one pays me or gives me free tools to say good things about them. Trading involves risk. You and you alone are solely responsible for any decisions you make. I'm not going to spend much time on this, but I have taken what I've learned from a number of smart individuals, as shown on this page, who I've talked about in the past, and I've developed my own trading style. I highly recommend you do the same thing. Don't take my word for it. Don't take any individual, but read, get educated, follow people on YouTube, maybe subscribe to things like Dan Fitzpatrick, stockmarketmentor.com, and then learn what works for you. I've had 20 plus years of trading to find what works for me and to get okay at it. I've bought a lot of problems over the years. Problems. Talk about Freudian slip. I've bought a lot of programs over the years, and I need TradeStation and Thinkorswim, and both are powered by specific indicators and strategies, many of which I'll use tonight. I do most of my scanning the markets after hours using HGSI. I work full-time, so I don't have the ability to do it intraday, and you can do that as well with an external data feed. EdgeRater automates a lot of the products or projects that I used to do by hand or in Excel, and then I've added the Q and Dr. K tools to my Armamentum. Now, I have brought several of these folks, Sagar, Dr. K, and others, to my videos, and it's important that you realize that I am not getting paid when you buy something. I am never paid by any vendor when you buy something that I suggest or use. If they offer an affiliate fee, which is the typical in this industry, I pass that, or I have them pass it on to you as further discount. I am an unpaid volunteer. This is just education. I'm emphasizing that because I'm now struggling with a data vendor who thinks just because he Googles me and finds my webinars and videos on YouTube that I'm now a professional, and professionals pay much more for their data fees. And I can assure you that I don't meet any of the requirements of a professional, which essentially means somebody else gives me their money and I trade their money for them, or I'm paid to help them trade. Doesn't occur, I'm not a pro. For HGSI, the software, which I am not affiliated with, except I'm a user and friend of family, the website's highgrowstock.com, and under investing strategies, you'll see hundreds of videos by myself, Ron Brown, and others. And then under free 30-day trial, they don't even ask for a credit card. Stock patterns are cyclical. So the NASDAQ feels like it's still going higher. The S&P kind of feels like it's in that uncertainty where it's struggling to get out of its current range. The Russell feels like it's rolled over this week, and the Dow is somewhere in between the S&P and the Russell. So this is a very difficult market because it's not all acting as one. So how you manage your positions is probably going to vary by where your stock, your industry group, and the markets that you're trading fall. I can tell you that I think uncertainty is rising by the day, and I've raised cash. I've reduced the number and size of my positions, and I've sold some premium. And I'll talk more about what I'm doing later. If I look at my sector review from Friday, this is in TradeStation. All I did in HGSI, I dumped the components of the various sector ETFs, and I look at it during the day, every day, to get a sense of what's working and what's not. So as you look at Friday, Friday was not a great day for me. It was a great week, however. You can see that materials are weak, financials are horribly weak, industrials are okay, as are staples, technology okay, discretionary was strong, utilities mixed, healthcare mixed, communications mixed, and real estate at best mixed. So you can tell what was leading to the downside. Now let's look at the major markets very quickly, and we're going to look at them in multiple programs, and I'll talk about why I've had some success this year, well, not just this year, frankly, and it's because of my top-down approach that I learned from Ian Woodward, and I'll talk about how I, the components of that, and the first one is the market. So here is the E-mini futures. Here is your all-time closing high. That occurred back in February. Notice that we have touched it a couple of times here. Well, I'm not going to show it. We have touched it on Friday, and we touched it on Wednesday. We still have not convincingly broken through the all-time high of the E-mini futures. That is a market that seems to me potentially topping. Now, I'll trade the market I get, not the one that I think we should have. The NASDAQ is totally different. Here is its February highs. We took out the February highs in June. We continue to go higher. What a massive bull market we're seeing here. And it continues to lead higher and higher. Now, at some point, you have to realize that this is getting extended. And as it gets extended, the risk will go up with it. Now, the Dow, not nearly as pretty. The good news is you've had the golden cross with the 50 above the 200-day, the 17s above the 50. So all the moving averages are lined up correct. It's in a shallow pullback of flag here. Had a positive day on Friday, and perhaps this thing will start to move and maybe the laggards can take over. But right now, compare this to the NASDAQ, which is way above prior highs, and the S&P, which is at prior highs. This is lagging. And speaking of lagging, very similar picture on the Russell. The big difference is this February high, or January high, as it may be on the Russell, is not their all-time high. All the other indexes that I've shown you, their highs this year are their all-time highs. Now, if we look at the VIX has come down a lot, but it's still significantly above where it was. Now we'll see if it can get above its 200-day moving average. And then the dollar, which have sold off a lot of late, bounced on Tuesday, and I won't say it's had a big move, but it certainly moved up and looks like it wants to go higher. That has implications on me and you if you have gold positions. On the weekly charts, I mean, the important thing again is we're hit the all-time high on the NASDAQ futures on Friday. We are pushing up at all-time highs on the S&P. The Dow and the Russell still have a way to go, and nothing else of interest. Rates eased on economic concerns. Hard to see, but there actually was a nubbing down on both the 10-year and 30-year. The AD lines diverged. On the big stocks, it keeps getting better and better. So you have very bullish AD line on the big stocks. I didn't think you could see it well over here, so here's a snapshot of the top. And notice how in the small stocks, the AD line is turned down again. In fact, if you look at the NYSE, you could see the AD line is turned down here, but what's leading are the Qs and the spiders, the big stuff, and everything else is starting to roll over. Breadth deteriorated, but not near oversold levels. Stocks above the 200, drop down a little bit, and it looks like you're in the 40% range. You're in the 60% range on those above the 40. Now, if you have more stocks above the 40 than those above the 200, that means on the majority of the stocks in the market, the price is less than the 200, but greater than the 40. So that means the 40 is below the 200. So we really not, despite those indexes, there's a lot of stocks that have not had the same type of a move. The 3-month new high, new low corrected considerably this week, are now in the middle of the range. And again, further evidence that breadth has deteriorated, although not oversold by any means. The daily McClellan, higher highs on the S&P and not on the oscillator or summation index. So we've got some clear divergences as well as on the weekly. So that pretends or foretells perhaps further weakness to come. Now the buckets are another way that I look at overbought, oversold. Take all the stocks in the S&P 1500 and then tell me how many are above in green or below in red the midline of their Bollinger Bands. And you could see on Friday at market close that 56% of the stocks were underneath the midline. So that's a small bearish tint. As I look at the distribution of stocks, there's more stocks in the red, but if I really look at stocks below the bands or above the bands to give me a sense that we're at a reversal time, and that's not here. If you want to know what a reversal is, look at March 9th, 2020, when 65% of the stocks in the S&P 1500 were below their Bollinger Bands, 97% were below the midline, and then on June 5th, before we had a small pullback, approaching 50% of stocks above the Bollinger Bands and 94% above the midline. I know what to do with the bottom. I don't know what to do with the top. That's sort of a neutral finding. Hindenburg omens, these have been famously promoted by Ian Woodward, who sort of rediscovered some a time ago, made him a YouTube and internet star. We expect to see Hindenburg omens at tops, especially at times when markets are about to have a correction. We're not yet at a top, and we have hit new highs on the NASDAQ, not yet on the NYSE, and there's really not a lot of new highs or new lows which you need to have to demonstrate a Hindenburg. Market tone remains strong. Yes, there's some yellow on the NYSE, but for the most part, the market remains in good shape, and we're starting to see some breakdowns in the sectors as, underneath those markets, we're starting to see some weakness. Now, this is one of my favorite tools from Sagar of Superior Profit, and this is his Q Edge tool. This is always running on one of my machines, streaming. The bad news, sorry, is it requires Thomson Reuters data, but it gives me a 1, 2, and 5 day performance, a 1 week, 2 week, and 1 month performance of the sectors in a real-time basis. Now, I did notice, and I think I understand the reason, they had only 1 out of 10 positive on Friday. Yet, if I look at the S&P sectors, and this is in stock charts, 1, 2, 3, 4, 5, 6, 7 were positive, and 4 were negative. I think the difference here is he's using the S&P 1500, not the S&P 500. And again, that actually plays to the story of the broader you get, the more weak you get. Regardless, the sectors were weak. And if you look underneath at the AD lines for the sectors, the industry groups, or the stocks, you see a lot of red. And that just calls out that weakness underneath. Now, end of day on Friday in the S&P sectors, technology led up 1.27. And my portfolio was helped along by Apple having another crazy day as it's running up into its split. Consumer discretionary was in second place, industrial, and real estate. The weakness was in energy, materials, and at least in the S&P 500 in the communication sector. Over here, if I break down the edge, and let me just show you how I use the edge tool. So as I said, this is going to be running real time all day long on one of my monitors. Come down to Insight, and I can update this at any time by either clicking on these icons. Sagar loves his icons, or on the calculator here, and that updates all of them. And it gives me some real-time best performing growth stocks, worst performing, best performing undervalued, worst performing overvalued, and so on and so forth. So I may find some nuggets there. I can go down at any time and look at performance of the sectors. Now, during the market day, it'll say real time, and one day would have been the prior day's close. Well, since the day is closed, there is no real time. And I can rank these by, up 1 through 11, or I could actually look at largest to smallest movement. Now, I can look at 1 day, 2 day, 5 day, and so on and so forth, all the way out to a year. And there's various different ways that I can rank them. Now, I use this. I can do some top-down analysis as well, where I might have said, all right, tell me in the top 3 groups, and the top 2 groups rather, if I hit these gears, it's going to open up the various industry groups under them. And let's rank them by leadership. And let's go down to 130. So these groups are all very strong. So I've highlighted them. I'm going to give them some love. And now I'm going to hit this. And what's going to happen is it's going to open up a list of the stocks in the S&P 1500 that are in these industry groups. And then if I go here and click on the 3 stars, the best of the bunch from a fundamental perspective will come up, and I might actually want to go and look at some of these. I could tell you that the negative story here is, for me, this is a fundamental-driven analysis, and I like charts. So sometimes I guess the word would be that they're at value play. For example, Horizon was one that looked interesting. But if I actually look at Horizon in TradeStation, HCO, this is not a stock that's buyable right now. It looks like it's topping here on the weekly, and it's selling off on the daily. But those fundamentals are not going to get worse in a short period of time unless there's earnings. So it's the kind of thing that I might be looking for to buy on a pullback. But it gives you, especially for other fundamental-driven traders, a great way to find stocks using fundamental analysis. Go back into my story. Proof of the strength of technology, especially the large stocks. Look at the canaries, all-time highs. Yes, I know that Priceline is bookings, and it may or may not truly be a canary, but I've used the same grouping for years. I learned it from Ian, and will that turn out to be an island gap, and will we reverse on Monday? I'd just say it wouldn't shock me. But right now, this is the strength of the market, and what a move. Week in review. I don't think I've ever seen this picture on the left before. What we're looking at here is ERG versus percent gain. ERG is a combination of EPS rank, 0 to 99, relative strength rank, 0 to 99, and group rank, 0 to 99. You add those 3 things up together, and you get a number up to 297 from, I guess, 3 to 297. Now this gray line here, which you can barely see, shows that at the tail and at the head, you have very few stocks. So I always disregard, typically from 40 on down because of the small numbers, and from 270 on up. And then I take the hot spot and I look at the shape of the curve. Believe it or not, we've run in 1 week from minus 7% performance from Friday night to Friday night of the low ERG stocks all the way up to 8% positive on the high ERG stocks. It just shows you high ERG growth worked. You could see as your earnings per share rank went higher, your performance was better. As your relative strength was higher, your performance was better. Stronger groups, stronger performance. I love seeing that because it tells me that the type of stocks I play with were working. On the right, I did a similar analysis looking from Friday the 14th to end of day on Friday the 21st. Same dates because there's nothing happens on the 15th. That was Saturday. And the first thing you see is there's more black than red. I find the S&P 500, it was up about 0.72. But then I find the IBD 50 was up 2.88. My stocks were up 4.51%. The best of the best in the smart groups were up 7.98%, even though they had more losers than winners. That's weird. Best of Woodward and Brown were up 16%. Breakout EPS All-Stars, one of the ways that I divide up my stocks was up 13%. So there were some major winners. But when I see my stocks and I see the IBD 50 and MarketSmith above the S&P, I know growth worked. And then down here, probably hard or impossible for you to read, but we have a list of the best of Woodward and Brown from last Friday. And it's interesting that big stock like Apple was actually up 8.2%, and Tesla amazingly was up 24%. The funny thing is I'm going to show you my return in a few minutes to date, and the only time I had Tesla I was short, and I actually made money on it, but that was a fluke. Know your news and earnings. Next week will be mixed again because jobless claims matter so much on Thursday morning. We got some revisions of GDP. We got some home stuff, personal income, consumer spending. Probably sentiment is important, PMI is important. So there's a number of things that are market moving that are going to occur. Doesn't look like we have many Fed heads. And one thing that I was thinking about is that the volume is likely to be low this week and next. As I heard today from one of my friends, how much traffic there was out of the city in Manhattan to the Hamptons. So this might be the 2-week vacation through Labor Day. Now, there's also quite a few earnings. Now, what disappointed me is several of the stocks that I was interested in buying, including, well, at least looking at some of the home builders. I own OKTA, so I'm going to have to figure out Big Lots. Several of these stocks, Billy.com, all have earnings this week. So you've got to know when your stocks have earnings. And frankly, buying a stock before, a day or two before earnings is very dangerous unless you really have an edge or you have a seasonality program that says, gee, over the last 10 years, it's been up 10 out of 10 times. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. We finished the week on a high note as Apple led the SPY and the NASDAQ to all-time highs. The Dow and the Russell lagged. Technology led sectors higher. You can see the Russell's made a big comeback from being down 25 to 30%. Now it's only down 7%. The Dow is down 2%, while the S&P is up 5%, and the NASDAQ, a super outperformer this year, at 26%. I had a strong week led by Amazon, Apple, and I did a crazy play on Zoom. I'm now up 1.867 million on a base of 1.4 in my real money actual trading account that I do as a model with these presentations. That's 133% gain year to date. Yeah, it's pretty amazing. The market continues a huge run off the March 23 lows. To me, it feels like the bad breath is going to catch up, and therefore I have to have 3 scenarios, as I was taught by Ian. My high scenario is market continues to run up to election. There's nowhere else to put your money with an accommodating Fed. Medium would be the SPY and the Qs take a pause, and the Dow and the Russell rotate into favor and catch up. That is probably a more likely than the high scenario. And the low scenario is the leaders sell off and close some of their outperformance. And I think that, to me, is the most likely. So if I had to rank them in likelihood, I think low, then medium, and high roads are what I'm expecting. Friday was options expiration, and I used that to close out several of my positions. I entered the weekend with probably my largest cash position. I've rolled up and out most of my remaining option positions and have a loose, bad word, don't like lose, loose collar on my Amazon. Yeah, that's the funny thing about this performance. I've had put protection almost since the market started rolling over in March, February and March. How do I explain my performance? Well, I think I cheat. How do I cheat? Cheat's the wrong word. I have a large account. That's the cheat. It makes it much easier to make a lot of money if you start with a lot of money. Okay, I use portfolio margin at TD Ameritrade. This gives me a lot of leverage. Hopefully, with Charles Schwab taking over them in the next few weeks, I'll be able to continue that. Then I use options to initiate most of my positions, which gives me additional leverage and frankly controls my risk. My favorite ways of entering a position are buying straight calls, buying verticals when there's very expensive options, expensive premiums. I will do synthetics, especially on lower price stocks, $20 stocks, $30 stocks when I can only go to zero and I know how much that is. And then I do my, what I call the Scott synthetic, where I buy a protective put on a synthetic as well. That's how I initiate my positions. I look at those options across the board, and then I decide which one makes the most sense. I roll up and out. What that means is, let's say I had options that were expiring or were getting close to expiration, and I made a lot of money, and let's say it was a August expiration. Well, I would want to roll it out to September or October, and I'd want to roll it up to a higher strike price so I could put money in my bank. Putting money in your bank is how you get big returns. Top-down investing works. I concentrated in the leading stocks and leading industries. I have a trading plan, which I follow. I hurt, and I'm joking when I say hurt my performance, by buying puts on my positions and portfolio protection when volatility increases. I get this return even with the protection. And I sleep a lot easier. I've learned over the years to avoid big losses. That's part of my plan. I let my winners run, and I ignore the noise of CNBC, Twitter, Facebook, the newspaper. I follow my plan. Let's do our typical top-down agenda, but I think based upon what I said about my thoughts about the market, I don't have a whole lot of great expectations for the general market. Now, just to prove I'm not a bunch of hot air and lying to you, although it's pretty hard to make up these numbers, just look at my Thinkorswim. And there it is, overall P&L to date, $867,501. And that was off a starting base of, let's see if I can get out of this now, of 1.4 million. Now, I live off this money. I have a salary from work. I'm one of the executive team and founders of a healthcare technology company. But I don't want to use that money. So I live personally off this. So the account will not add up to 1.4 and 1.8 because I just bought a new house. I bought a few other cars. And so this is how I make the money so I can spend it, so to speak. All right. Again, top-down investing, market matters. So let's look at a couple things that I might look at. I always like to go to this on a daily basis. So let's look at the E-minis, and let me just talk about what I'm seeing here. Number one, am I in a buy signal from John Person or a sell? I'm in a buy on the daily. I'm on a buy on the weekly. I'm a buy on the monthly. Hard to be bearish when all those are in a buy. I look at the paint bar. Is it green? Is it blue as it is on the daily and weekly, or is it red? These are an Alexander Elder indicator, and what it says to me is if it's green, I should be long or holding, I should not be shorting. If it's red, I could be short or holding, I shouldn't be adding to my longs. And if it's blue, I can do whatever I want. So we got blues on the daily and weekly. So that tells me that we got a little bit of fatigue here. What do those red dots mean? Well, the red dots is another sign that I might be concerned about the market, because the red dots indicate a MACD divergence, and you could see how the MACD has gotten lower and lower and barely positive despite higher and higher highs. Then I come down here and I want to look at this middle green dot, because that tells me my weekly bongo is green, and that's my trend indicator over the intermediate term. And then I look at my high jump bar, and it's at 69%, which tells me I'm not overextended. I'm not surprised because it's gone sideways here, and enough to even get rid of the MACD divergence, and it's not near the top of its envelope. So I see this. If you told me it's going higher, I'm not going to argue against you. I'm more looking at the time and how far it's come. If I look at the Dow, it doesn't look nearly as good, but interestingly, the Dow had a new buy signal come in on Friday. It's also in a weekly and a monthly buy. It's at 50% here in green. So the Dow, maybe it is going to rotate into favor, and we're going to see these 30 stocks that we worry so much about go higher. The NASDAQ, notice how the NASDAQ, this one is probably the most worrisome for risk of the bunch. It's got green, green, and green, so that's good over the 3 time frames. It's got green bars, that's excellent. It's got the MACD divergence here, that's not excellent, that's concerning. It's at the top of the envelope, so it can run up the envelope, but ultimately it's going to pull back. But what's really bothersome is at 96% on the high jump bar. And when I see the NASDAQ get to that level, it may go here for a while, but typically these things will roll over. And so I think the NASDAQ is showing me where it probably is at risk of, at the minimum, it's sometime soon, some sideways move. And then lastly, the Russell in a sell signal, clearly different than the rest. If I look at the VIX, the VXX, here you could see the green dots would argue that there's MACD convergence, but it can run a long time before you see the model change. And then the dollar, I mentioned it showed some strength this week, and I think I've got the dollar right here. And you could see the dollar had a buy signal on Friday. So even though I still have some gold, I took a lot of profits on my gold positions and my gold ETF this week. And you see gold is red, doesn't look that good. But, frankly, gold has still had a big run, and I'm not sure gold is done. We will see. Now, I also like to follow the ETFs. And you could see here the spider, the Qs, the diamonds, and the IWM. This is using a number of different indicators from Sagar. Add that my dots, the bongos, the Roy Kelly cycle indicators. I love the trend lines that are written, auto-populated by Sagar's Q tools, and the arrows are from John Person's indicators. So very quickly, the spiders just look like they are slowing down to me, and the yellow perhaps is giving me that little bit of caution. These red pluses are stretches, just telling me that it's getting a little bit extended, and often you see sideways or pullbacks when you see those. I look at the Qs, and they're just unstoppable. They are above what's called their outer boundary, so they're very extended, leading this market. The diamonds pulled back. This is a daily chart, but had a nice move on Friday. Maybe they're going to move up. And similar to the Russell, but they did not show a reversal. This is something else that I'm watching, either the ETFs or the futures during the market open. In HGSI, I do the same analysis on a nightly basis. I wish I could tell you the market's great, it's going higher and buy, 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 buy. I'm a little bit more cautious this week. So let's do the typical evaluation. Let me find my major markets plus, hit my warehouse view, and it's going to pop up adjacent to this. And there's 27 of these. So let me run this up here. And by the way, for whatever reasons, I was having problems with Snagit, so I'm using a new type of recorder today. It looked like it was recording in 4K and it was fine. We'll find out the hard way, won't we? If it's horrible, I'll re-record it, but hopefully it'll be okay. So I'm going to look at top-down view and major markets plus. I want to rank it by the combo rank. And the strength of the market last week was the NASDAQ, hence why my account went up a lot. The IBD 50 ETF moved its way up to 4th place, even though I had a rough day on Friday. As my account did, it was up on the week nicely. The laggards were the minors and the small and mid caps. So an interesting week where the small caps are lagging and the NASDAQ is leading. So let's just take a quick look at the major indexes using HGSI. Again, don't be confused by the fact that I call myself HGSI Doc. I am not an owner, partner, equity participant. I am just someone who loves this program and likes helping out with George and Matt to help their new users figure out how to get value. So we start with the S&P 500, and we'll close that. We don't need that. So huge move off the bottom. How high has this moved? Closing high, 54.5% in 106 days. That's a 0.5% a day move in the S&P 500. I'm not going to say that's historic, but it's a pretty impressive move. Notice that here's the prior highs that we struggled, although I believe we did close on the S&P 500 at its all-time high, barely, on Friday. When I start drawing lines, it looks like it's slowing down. Does it break on through and go to all-time highs? Does it continue to struggle with it and go sideways, which would be fine with me? Or does it say, I'm done, and come back down and test the 200? And that's your high, your middle, and your low road scenario for the S&P 500. If I look at the Dow Jones Industrial Average, we know it's weaker. It's nowhere close to the prior high here. But again, if you look at it, it's come a long way, and it's up 52% in 106 days. It just is nowhere close to its prior high. If I look at let's go to the Russell, then we'll come back to the NASDAQ. The Russell 2000, again, nowhere close to its prior collapse high, but a nice uptrend, steady uptrend. It would not shock me if my middle scenario came true, which is the Dow and the Russell start to outperform and the NASDAQ heavyweights take a breather. And believe me, if Apple, Microsoft, Amazon, Google, Netflix, so on and so forth, went sideways, the S&P is not going to have a big move up. I think the top 11 stocks now are about 58% of the weighting of the S&P 500. So the NASDAQ, drum roll for the star of the day, look at this move. Whew! Continues to plug higher. Look, the only downside of this thing is this. 70% move in 106 days. How long can this go before the fact that it's at its high jump says it's time to stop? Look at the weekly. How many times have you seen a weekly market do this? Somebody show me, I'll show it in Thinkorswim, a long-term chart of the NASDAQ and the S&P, and it really gives you a better sense of how overbought they are. Very quickly, let's look at the dollar. And if you've never been here and wonder why I'm spending so much time on the market, why do you think I make so much money? You got to know when to hold them. You got to know when to fold them. And 70% or more of that move is going to be by the stock market. Bouncing around the bottom on the dollar, 2 kahunas in the last 3 days is very bullish. If I want to look at the VIX, the VIX is sideways. And then, as you know from before, just very quickly, gold sold off, had a doji on Friday. Did not hit its chandelier stop on the weekly. That's interesting. So it could be a place you might expect it to hold and bounce. Gold miners, similar. Not a bad chart. When I looked at the majority of the stocks, this probably looks better than the majority of the stocks, holding above its 50 and 200-day moving average. And somewhere in front of my face is the silver, which is right here, which is also pulled back some. Now, let me show you what I was talking about in Thinkorswim. Let's open up the spiders, for example. And let's look at a very long-term chart. I know I should be able to get more of this data in, so let's see if I can. All right, see if I can make a new one. Time frame. Max available. All right, obviously the numbers are compressed to the left. Here was a double top. It took us from October of 07 until October of 13 to break that double top. But look at how far we've run. Does that look like something sustainable to you? At some point, we're going to take a breath. If I look at the same way on the NASDAQ, that's not the same as it's supposed to look. It has gone hyperbolic. When I've seen markets in my short lifetime of trading go hyperbolic like that, they don't stay that way. So these worry me a lot as far as correction risk. Now, the next thing I do as part of a top-down investor say, well, what industry groups look best? So I go to the, not that one, industry groups. I hit warehouse. It pops them up over here. I've got 175. Now, I want to look at these with 2-day force, and this tells me short-term momentum to the upside. I had 20 groups. 2-day force to the downside, I had only 14. Now, look at these 14 if you're a growth stock investor, and then tell me how we had such a good week. Biotech, e-commerce, application software, infrastructure software, casinos, airlines, payment, internet, entertainment, internet, security. It's amazing how good we did. And perhaps it was Monday through Wednesday, and it was the last 2 days. You can certainly see on Friday, all these were down. If you look at a 5-day window, 69% of the 175 stocks were down, and only 26 were up. So I think this market is weaker than it feels. If you look at some of these groups, so I right-click on home products, then left-click on change to industry group, it brings up lows, double-click on lows, and you could see, just like the NASDAQ, a beautiful run off the March lows. It had earnings this week. They were great. The stock is extended. It's up at the high jump bar. Probably a great stock to own. If you own it, I'm not sure I'd be chasing it here. I'd look for a pullback. Similar to Lowe's was Home Depot, also had good earnings, but pulled back some. I want to find it when it's doing this, going sideways for a while, which will give you a squeeze, and then look to buy it on days like this when it's got kahunas, pocket pivots, mobile breakouts, and a squeeze. I'll wait for it to come to me. I try not to chase. Kirkland's broke out. I had looked at this one earlier. Too late for this. Williams and Sonoma. This one just broke out back here and has run some. It's not here sitting in the group, but I've been playing Restoration Hardware, and Restoration Hardware has had a huge run as well. Another great stock, as we keep going down the list here, At Home. My wife said not to buy it, and I wish I wouldn't have listened to her because look at what it did. This is when I was looking. I had a Bible gap up here and took off. I love my wife, but she'll be the first to admit she's not a stock person. And here's Tractor Supply, another big run, sideways move. Hard for me to be chasing these, and that's one of the challenges here. I look at Auto Index, you know what we're going to see, Mr. Tesla. Mr. Tesla now closing for the first time, I think, above 2,000. Doji there, kind of the same thing as I brought up on the Canaries. Is this, or the FANG stocks, whatever you want to call it, is this going to turn into an island reversal gap, or does it continue to run higher? It's running higher because it's exceeding expectations on number of cars. Just bought my son a Model Y this week. He's very excited. It's got earnings coming in, but they've also announced a pretty substantial split. So Tesla looks great, but how do you buy this here? This was a great opportunity. Mobile breakout from a squeeze, pocket pivot, and kahuna. That is my trading plan, folks. Find stocks in uptrends, pulling back to support, and then give me that pattern. And that's what I want to look for. NEO, it's a Chinese play. I don't know how real it is. I'm not interested in it. Generic pharma, Momenta is a buyout up here. That's the only one above the industry group. I'm not buying it. It's already been bought. Mass merchants, that was kind of interesting. Of course, I have some Walmart, which isn't doing well or doing anything but Target. Big run up here, I think, on earnings, and then maybe giving us a flag opportunity. These are all run. BJ's Wholesale taking off here, a little bit less expensive stock coming out of a squeeze. I think I put that on my buy watch list. Costco, I also have Ollie's on my buy watch list as well. We'll talk what that means in a little bit. And Big Lots, just a nice little stair-step pattern. I'd rather buy it when it pulls back. But this one's got amazing earnings per share growth. Maybe I shouldn't wait. It's under accumulation, and it pays a bit of a dividend. So Big Lots looks very interesting here. Dollar Tree, I just wanted to look at Five Below. It's in a squeeze. It had a kahuna. Just doesn't have any oomph. I'd rather have them pull up, pull back, and move. This has been going sideways now for several months. Back. Home builders, I'll show you how I'm playing these. These look great. D.H. Horton, one of the best looking stocks in the market. Good earnings per share growth, twice or more than its multiple. Home building is on fire. You've got the escape from the cities like New York, and you've got low interest rates. Again, these are all extended, or several of them are extended, but they're probably going higher. There's Lennar, Toll Brothers, Pulte. Now this one looks more buyable. Taylor Morrison, less exciting earnings per share growth, sideways move, squeeze, and had a mobile breakout, a pocket pivot, and a kahuna. As I said before, that's the type of pattern that I am looking for. Now, I did not buy an individual name. I am in ITB, and ITB looks just like the individual names. And I rolled my options up and out, took some profits, but I'm still in the position. Life science equipment, an interesting story, because usually when two companies a merger gets called off, they both fall, or one falls, one goes up. Here's a case where they both went up. So Thermo Scientific Fisher was looking to buy Qiagen, sideways move here in a squeeze. This is something I'm going to be watching, good earnings per share growth. Fluidigm, a cheap stock, don't know much about it. I bought some down here and I got shaken out of it back up here, didn't go back in. OraSure, this is a flyer. If they may be involved in some of the oral saliva testing for COVID. Abbott Labs, the old persistent turtle, 1.4% dividend, sideways move here. Mobile breakout from a squeeze. Pocket pivots, kahunas, new John Person buy signal. That could be interesting. And I want to show you Qiagen. When the merger was announced, was off, it pulled back, and then it's off again. I think this is one that's interesting. Again, good earnings per share growth, as do several of them in this group. And then I don't know anything about Cardiff Oncology, but when I see this pattern, I bought it. So I bought it back here. There's another opportunity this week. Wait for it to pull back, but something's going on with this company. It's had a huge move from 1.5 up to 7 and 8, and my guess is it's on its way to go higher. Renewable energy. I like Ballard Power here a lot. Why? Because big move, pull back to the 50, kahuna, pocket pivot, person buy, mobile breakout from a squeeze, in a strong group, 4 million shares traded a day. I would want to see it break above its chandelier stop, but a break above that might be interesting. Some of these have had big runs and now slowing down. This is Sunrun. Wasn't in that. I wish I was. Vivint Solar, SunPower. But I would put in this group because of power, though I think it's more in industrials, is Generac. And I gave that one to you back at $100. It's going to double. It's in the high 180s right now. And again, it's another stock that I got into when I gave it to you back here. And I've rolled it up and out with my options plays. It has not triggered a stop, although I've taken profits all along the way. Packaged food doesn't interest me too much, but if I can get over the fact that this is Herbalife and all the Ackerman and Icon fights that they had, here's a stock with a big uptrend, pull back to the 50, a kahuna, a pocket pivot, a brand new John Person buy signal, and a mobile breakout. Looks very compelling. It's on my buy watch list. Mondelez. And then healthcare services. You know, Teladoc. It's been relatively volatile here. I don't like that candle, but this is one that's been a great performer. Of course, I owned it back when it was less than 100 and missed most of the run. Invitae, another test. They have some molecular testing, some drug development tools, a number of things. Had a big gap up here on news. Looks like it wants to run again, so I put that on my buy list as well. And then rounding out the top 10 restaurants, not my favorite group, but what about Shake Shack? All right, it's a different type of a buy. All right, it's just breaking above the 200. Had a couple pocket pivots in a row. I like the market catcher going up as the stock was going sideways on the weekly. Also broke up there. I think this one looks interesting. Clearly under demand. There were a number of those that looked okay. On the shorting side, and I think it's time to start thinking as well on what do you do if the market goes down. I'm not a great shorter. I'm the first person to tell you. I watch them too closely. I don't give enough room to run. But I always like to come up with a list of stocks that are potential shorts, because if they start falling, then I know that the market's probably going down. So what you're going to find are stocks that are rolling over. This is Alexandria Real Estate, one that we were looking at buying earlier. Mobile breakdown. Still above the 50. I'd look to see it break the 50 before I got interested. Analog devices breaking down below the 50, mobile breakdown, New John Person sell, kahuna to the downside. CDW Corp has failed multiple times on that 200-day moving average. Chubb failed at the 200, looks like it's rolling over, maybe it comes back down to 95. Fleet Corp, a credit card for truckers, clearly looks like it's rolling over. And what I want to do is I want to find stocks. This is not one I would short yet, but I'm just watching it. I want to find stocks that have broken down, retest, and fail, and then short them on this rundown. Because you don't really know that this stock isn't just going to go sideways and then rally. Jack Henry, expected to bounce here. KLA Tencor, not yet, but I got a new person sell, a pocket pivot to the downside, and a kahuna to the downside. Laboratory Corp of America, it's about to break through its 50. And again, drop below, fail, and head back down. Talk to me about shorting it. Marsh & McClellan starting to roll over. NASDAQ Biotech, here you go. Here's your break below the 50, failed retest. I think this is going to go down 10, 15 points down to that 200. Pindalu, one of these high-flying internet discretionary plays. Broke down below the 50. The 200 is a long way down. Everything's red up top. Mobile breakdown. New John Person sell. Pocket pivot to the downside and kahuna to the downside. You can put your stop right above the high of that day. If it closes above the 50, you probably don't want to be in it anymore, but that one looks like it's at risk of coming down. Corvo early. Regeneron's another one, and this is really scary for biotech because this has been a leader, and it looks like it's rolling over here as well. I'll be watching that one. SolarEdge has had a big run. I wouldn't short it here. It's more for looking. So what I've done is I take a list of these stocks, and I'll be monitoring them. And when I start to seeing big moves down there, if I see those, I'll know that I want to get less and less long and start going more short this market. I did put together a buy watch list. It's kind of the shortest one I've had in ages. I'm going to go through it very quickly because there's only 29 stocks. Not all of them are buyable right here. I'll tell you why I liked them. Alibaba, I think it's probably one of the premier Chinese properties. It's got earnings and growing earnings. High base, it looks like it's breaking out here. You've got coming out of a squeeze, had a mobile breakout 2 days ago. John Person buy, pocket pivot and kahuna. So this is one thing that looks interesting. Earnings are already out. Aventor, healthcare stock, big run up, sideways move, off the 17-day here, mobile breakout, new John Person buy, pocket pivots, kahuna on rising volume. D.R. Horton, this is one of those home builders that's going to the moon. BJ's we already looked at. Thermoscience Fisher we looked at. Steak Shack we looked at. Ballard Power we looked at. Invitae we looked at. Knight Swift, the truckers look good. And what I liked about this one is it just broke out of its chandelier on Thursday, coming out of a squeeze with a mobile breakout in a John Person buy, pocket pivots and kahunas. Makes money. We looked at Abbott. We looked at Ollie's. Public Storage is a REIT, looks just like Steak Shack, where it broke above its downtrending 200-day moving average. This would be an early, riskier buy. It does make money, pays a 3.9% dividend. Herbalife, we talked about. Anaplan, this is a software company, doesn't make money. What I liked about it was when I saw these pocket pivots in a row here, still in a squeeze. I'd like to see it break out. Give me some kahunas. I might be interested. Yeti, I have a bunch of their things on my boat. They have retail stores, obviously look like they're doing well. They already make money. Sideways move, you have a squeeze. Person buying some pocket pivots. This is interesting. I'd be looking for some momentum with some kahunas coming in. Yum Brands. broke above all these moving averages, including the 200, in a squeeze, multiple pocket pivots. Vivint Solar, not yet, but it's going sideways after a big run-up. I'd be looking for some kahunas. Ventas, this is one of these senior citizen REITs. They got hammered, especially with COVID. Making its way back slowly, pays a 6.8% dividend, has great earnings per share growth. Is it a perfect stock? No, it's still below the 200. But if it can break above it, it might become interesting. Taylor Morrison we looked at. iRobot, what I liked about this was I don't like it yet, but if it breaks above the 50s, it's going to be interesting to me. It's also a high close doji on the weekly, which is a good buy signal. Kiagen we looked at. MDC Holdings, another one of these great housing stocks. What makes this one different? It's actually going sideways here and gave us a good buying opportunity on Friday with a mobile breakout from a squeeze, a John Person indicator, buy, and a kahuna. Don't know anything about this company. Its volume is barely okay. A breakout above the chandelier, electrical component company. YY, I bought some of this. It's flagging here. I'd have to see it break above the flag. And then here's Mimecast. I don't know why I picked it. It's going sideways, had a mobile breakout from a squeeze, a new John Person indicator. Here, pocket pivots, kahunas. That must be why. Cadence Design, a big leader. It's got a little bit sideways here. So is it giving you an opportunity to buy it on the pullback? Billy, sideways move. I don't have a buy signal. I just wanted to have it, so I tracked it. And Soho, sort of a pullback on a flag again. I don't have a buy signal. I want to keep it for tracking purposes. Quidel, what a great leader. Sold off hard from 312 down about 230. It's hugging that 50-day moving average. Great earnings per share growth. Something tells me it's not done yet, and I'll look to jump in when it shows me a buy signal. And that was my buy list. It's a small buy list. Now, you're sitting there going, how can I watch that many stocks? There's a couple different things I can do. One thing that I can do is I could create in TradeStation a radar screen where I'm monitoring a large number of stocks and signals during the day so that I could act if I ever have time to sit down and look at my computer. In Market and Thinkorswim, you can do the same thing in Market Watch, where I'll load my buy watches here. And I'll be looking for some of these signals that I already have as opportunities to move into these. So, on that note, if I offended you with my performance, I apologize, but I think it's important if you're going to spend the time and listen to my webinars, you get a sense of whether or not I make money or not. I do, and I have for years. Of course, saying that probably means I'm going to stop. Have a safe week. I do think that the risk is higher to the downside than to the upside here, and I've set myself up to be prepared. Talk to you in a week. Goodbye, everybody.